Exercise 17-22B deals with a speculative derivative, and I'll clarify in a minute what a speculative derivative is and the accounting for speculative derivatives. In this particular case, the derivative is a put option. A put option gives the holder the right, but not the obligation, to sell something at a specified price during a stipulated span of time. The holder of a put option benefits if the price of the item declines. It's the opposite of, as an example, a stock option. If you hold a stock option, that's a call option, and you benefit if the value of the stock increases. Here, in the case of a put option, you benefit if the price of the underlying item declines. So the accounting for derivatives depends upon whether the derivative is used for speculative purposes or hedging purposes. A speculative derivative is a derivative that you buy in an effort to earn trading profits by predicting future price movements of some underling and being on the right side, the correct side of the price movement. In contrast, derivatives used for hedging are an effort to control risk. Speculation is done to earn trading profits. Hedging is done to reduce risk. In exercise 17-22B, we're not explicitly told, but the authors of the problem want you to infer that this is a speculative derivative. So we're going to work it based upon that assumption. In the case of speculative derivative, well, in the case of all derivatives, the derivative instrument is reported at fair market value on the balance sheet. But the income statement effect differs depending upon whether the derivative is a speculative derivative or a hedging derivative. And even within hedging derivatives, there are differences in the income statement impact of the derivative. And we'll talk about that in a couple of problems. With respect to a speculative derivative, again, reported on the balance sheet fair market value, and changes in the value of that derivative runs through the income statement. Okay, so that's the setting where we are in this exercise. We're accounting for a speculative derivative where that speculative derivative is a put option. So specifically, we've got a company, Color Company, they bought a put option for $800 on Chaco Company common stock. This happened on April 16, 2014. The put option gives the holder of the option, Color Company, the option to sell 5,000 shares of Choco stock at a stipulated price called the strike price, at a stipulated price of $25 a share. And this option spans for a 12-month period of time. So at any time within this 12-month period of time, Color Company can exercise their option and sell 5,000 shares of Choco stock at a price of $25 a share. So obviously, Color Company is going to benefit here if the market value of Choco stock goes down, because they'll be able to sell something at a higher price than what its prevailing market value is. So the market price of Choco stock on the day that Color Company purchased the put option was $25 a share. And they tell you parenthetically that the intrinsic value therefore is $0. The intrinsic value is simply the difference between the stipulated price or the exercise price and the prevailing market price of the stock. If the prevailing market price of the stock on that day had been, say, $24 a share, then the intrinsic value of the put option would have been $1 per share. Okay, they tell us that time marches on, and on June 30th, 2014, the market price of the Choco stock was $24 a share, and the time value of the option is $550. Now, if you remember back from the class discussion, I said that there are two components to the value of an option. There is the intrinsic value, and there's the time value value. And so those two components of value together reflect the total value of the option. So what we're asked to do here is to prepare the journal entry to record the acquisition of the put option on April 16, 2014. Real simple. We paid $800, so we debit $800 in the investment in put option, which is an asset account that's reported under the assets of Color Company, and we credit cash because that's what we paid. You'll notice that I've got a T account set up here to reflect the general ledger account investment in put option, and the adjusting journal entry or the journal entry that I just made to book the acquisition automatically posted over to the T account. Okay, so time goes on. Here we are at June 30th, 24, and we're asked to prepare whatever adjusting journal entry is appropriate at June 30th, 2014. Well, as I just mentioned a second ago, derivatives are reported on the balance sheet at fair value. So what we need to do is we need to figure out what the fair value of the put option is at 6/30/2014, and I'm calculating that here. And consistent with our discussion, I show the calculation of the value of the option is consisting of two components: the intrinsic value and the time value. We're specifically told here that the time value at June 30th is $550, so that's simply a drop in there. The intrinsic value of the option is the difference between the exercise price on the option and the market price of the Choco common stock on June 30th. The market price of the Choco common stock on June 30th is $24, $1 less than the exercise price. So the total intrinsic value of the option on this date is the difference in exercise price and price of the Choco company stock multiplied times the number of shares covered by this option. The option covers 5,000 shares, so 5,000 times 1, $5,000 is the intrinsic value of the option. So the total value of the option is $5,550. So we need to prepare an adjusting journal entry that will bring the balance in this investment account from $800 up to $5,550. So I believe that difference between 5,550 and 800 is going to be $4,750. So we're going to obviously debit the investment in put option account 4,750, and the offsetting credit is to the unrealized holding gain or loss dash income account. It's shown as dash income because this gain or loss on this derivative is going to flow directly through the income statement, and the reason it's going to flow through the income statement is because this derivative is considered held for speculative purposes. If the derivative were held for hedging purposes, that gain might or might not go through the income statement depending upon additional facts. So let's see what we posted the debit to the investment account. We need to credit here the investment, the unrealized holding gain or loss. And so there's our two T accounts updated. So let's determine the balance in the investment and put option account. So the total balance in the investment and put option account at 6/30/24 after we prepare that adjusting journal entry is 5,550, which is what we desired. That equals the total value of the option. Part C of the problem asks us what was the effect on net income of entering into the derivative transaction for the 3-month period ending June 30th, 2014. Well, it's simply this 4,750 gain embedded in this unrealized holding gain or loss dash income account that's going to show up on the company's income statement as a separate line item, unrealized holding gain or loss, on speculative derivative, and it'll of course show up as a positive component of net income because it's a gain.